Good afternoon, everyone. Thank you so much for being here. My name is Kelly Crum, Brand and Content Manager for Maryland Realtors. I want to welcome you all to our 2026 Economic Outlook webinar. Today, we have with us Maryland Realtors Strategic Communications Director, Dan Petrell, along with special guest, Chief NAR Economist Lawrence Yun and NAR Economist Anat Nusinovich. Together, they will dive into the 2026 projections, mortgage trends, and unemployment insurance data. We do encourage your questions, and we look forward to answering them. Please post all of your questions in the Q&A box below at the bottom of your Zoom screen. And with that, I will turn it over to Dan. Dan, take it away.
Hey, thank you, Kelly. And thank you, everyone, for coming out and visiting us. We are delighted to have two of NAR's top economic brains here today. Give a quick introduction here. We have Anat Nusvanovic. She is an economist at NAR, and she is responsible for analyzing residential real estate markets, trends related to migration, mortgage applications, and labor market trends, including the housing shortage tracker and the residential snapshot reports. And then soon she will be joined by Dr. Lawrence Yun, everybody knows him, chief economist who oversees the research group at the National Association of Realtors. He supervises and is responsible for a wide range of research activities for the association, including NAR's existing home sales statistics, affordability index, and home buyers and sellers profile reports. So I'm going to take a step back and give it over to Anat and invite you to take it away. Thank you, Anat.
Thank you, Dan. Hi, everyone. Really nice to be here this afternoon with you. Just give me one moment to share my presentation and we can begin.
Looks good.
Okay, perfect. So, as Dan mentioned, some of the things that I work on are mainly kind of mortgage applications data and the labor market. So I'll be giving an overview of what those look like right now in Maryland, before Lawrence joins in for his economic overview. There we go. All right, so when we think about where market opportunities lie for 2026, one of the main indicators that we look at is the impact of mortgage rates. So the latest data that we have from the Home Mortgage Disclosure Act in Maryland shows that home purchase loan applications were at 117,138. That's approximately 2% of the 6.5 million nationwide applications for home purchase loans only. Now, not all loan applications end up being homes that are bought, loans that are originated. But that year in Maryland, 55.7% of these applications turned into home purchase loans. And that's higher than the national share of originations, which was 53.7%. The denial rate in Maryland is relatively low compared to other states and compared to the national level at 6.8%, which is great. And the average mortgage rate in 2024 was at 6.6%, which is in line with the national average as well. Now, to gain a sense of what demand for home purchases looks like, we take a look at the number of mortgage applications data that sort of works as like a proxy indicator of housing demand. So 2023 was a historically low year for mortgage applications, mainly due to higher rates at that time. But 2024 sort of marked a pivotal change in that, with mortgage applications starting to really pick up as rates are decreasing. So loan applications were up in Maryland by 3.2% in 2024, which is great and in line with the national trend and what we're seeing and what we're also expecting to see when the data comes out for 2025. I'm sorry, just one second, my slides disappeared on my end. There we go. Okay, but the interesting part and what we're interested in when we think of mortgage rates is what would actually the impact of lower rates look like in the market. So, based on our analysis, at a mortgage rate of 7%, there are 978,000 approximately households that are able to afford a home in Maryland with a 7% mortgage rate. Now, if the rate goes down to 6%, we see an additional of 115,000 households being able to afford a home in Maryland. Now, the fact that they're able to afford a home doesn't necessarily mean that they will purchase a home. From historical numbers, we see that about 10% of homes that are able to afford end up buying a home. So that would mean that this decrease in the mortgage rate would translate to 11,500 more home sales. Now, the main effect of the rate drop would be on monthly mortgage payments for household, which could drop by $255 for households in Maryland if the rates decrease to 6%. And we see that if we take a look at the data from the last decade, so between 2015 to 2025, monthly mortgage payments are on the rise. So even a difference of $255 will make a big difference for a lot of households that will finally be able to afford their monthly mortgage payments and will end up making the decision that they can apply for a home purchase. I wanted to highlight two major metropolitan areas in Maryland to kind of give more of like a zoom look into what would this look like in local markets. So for example, when we talk about the Washington, Arlington, Alexandria area, in the DC area, with a 7% mortgage rate, you have there are approximately 901,000 households that can afford mortgage. 150,474 of those households are renter households that can afford the mortgage and could potentially become homeowners. If the rate drops to 6%, we see an additional of 123,000 and a half more households that would be able to afford the median priced home in that specific area. And that includes 35,800 renter households that could potentially turn into homeowners. And again, 10% of all these households will turn into homeowners within 12 to 18 months from what we've seen in the data. And then similarly in the Baltimore, Columbia, Towson area, we see an additional of 55,148 more households that will be able to afford a home if mortgage rates fall from 7% to 6%. Now, other indicators that we will watch in 2026 include income and job growth. While I won't be talking about sort of like the national job additions or anything like that, I like to look at unemployment insurance claims because this is the timeliest data that we have showing what's actually happening in the labor market in local markets. So it's weekly data provided by the Department of Labor by state. So looking at Maryland, we see that both initial and continued claims are below the pre-pandemic levels, which is good. Now, there are two types of unemployment insurance claims that we look at. The first is initial claims, which is the first initial claim that a U.S. worker applies for when they apply for unemployment insurance benefits. And then there are the continued claims, which are claims that are, U.S. workers that continue receiving unemployment insurance benefits. And continued claims serve more as a measure of long-term unemployment. So that kind of can give us an insight of very early changes in the labor market and of what's going on. Taking a closer look at the effects of the federal government layoffs, obviously Maryland has been affected by the layoffs in the federal government beginning last year. And based on the 4-week average, we see that initial claims are kind of starting to decline. But continued claims, which, as I mentioned, is a proxy for continued unemployment, is holding pretty steady and even increased in Maryland over the last two periods. When comparing what's happening in Maryland to Virginia and DC, which were also affected by the federal layoffs, we see that Maryland is unfortunately leading with continued unemployment claims. However, I will note here that, as I showed in the previous slide, this is still below the pre-pandemic levels, which is good. And if unemployment claims remain stable and we continue to see the mortgage rates decrease, then we would see more home sales in Maryland. I also mentioned income growth as one of the indicators we're looking at. So let's just take a quick look at how income growth has been trending in Maryland. So for 2023 to 2024, median family income in Maryland increased by 8% compared to 5.3% in the US. So income has been sustainably growing in Maryland since 2021, which is really important for supporting consumer spending and the confidence of people to be able to make a decision such as buying a home. Now, homeownership rates essentially remained unchanged in the last decade, mainly due to high mortgage rates and property values. So this is despite consistent income growth and consistent job additions to the labor market. In 2024, the homeownership rate in Maryland was 68%, and that's compared to approximately 65% on the national level. But again, this data is from 2024. Mortgage rates are now lower than they were that year. We expect to see them decrease further. And really for homeownership rates to rise above these levels, we want to see mortgage rates decrease further. To sum up, I wanted to highlight again two of the main metropolitan areas in Maryland, this time to highlight housing affordability in those areas. So at NAR, we measure affordability using the Housing Affordability Index, which basically measures whether the typical family can qualify for a mortgage loan on a typical home. What this index basically means is if it is higher than 100, it means that a family earning the median income can afford the median home in that specific area. So in the DMV area, we see that the Housing Affordability Index was at 108. And we see a higher index for Baltimore, which was at 130, nearly 133 level of index for the Baltimore area. Now, this statistic can be found on the Metro Market Statistics dashboard that we have set up for realtors only, and you can find other metropolitan areas in Maryland on the dashboard there as well. Thank you so much. That is all from me on kind of mortgage trends and unemployment trends, and I think we'll take Q&A is gonna be at the end of the presentation. So thank you so much.
Thank you, Anat. And Dr. Yoon, it's up to you now.
Great. Thank you, Daniel. And also my colleague, Annette. Both of us graduated from University of Maryland. So, thanks for Maryland Association of Realtors to invite me. I am in Frederick County Association of Realtors Board office because nearby they had the local association in-person lunch meeting where I gave presentation, which was the reason with the traffic, even though it's a short distance, uncertain as to why I could not get right at the top of the hour. But thanks for your patience. And I'm sure all of you are looking forward to what's going to happen in 2026. Annette covered things like the job market situation, especially with the DOGE impact, impacting the Maryland region much more so compared to the rest of the country. I mean, the Maryland suburbs, District of Columbia, Northern Virginia, certainly much more concentrated from DOGE impact compared to the rest of the country. So let me put my PowerPoint slide onto the screen and give you my assessment of how the market will play out this year. So let me put it on the full screen mode here. All right. So let's first ask the broader macroeconomic question, which is, are we headed towards economic recession? Certainly feels like it in DC with the impact, again, of the DOGE cut. We are seeing large job cuts, fewer employment condition. But nationwide, because Federal Reserve policy will be guided by national economic data and not what's happening only in the few states condition. So the national condition is first, during the longest government shutdown of last year, September, October, longest government shutdown. There was no government data on GDP, employment figures. So we really did not know. We were flying blind as to what was happening during that condition. Of course, now we have the data availability. We're analyzing. Annette showed you some of the data point. But this Saturday, are we going to face another government shutdown? According to the prediction model, prediction market is where incredibly, there's a lot of apps available today where you can make a bet about who will win the Super Bowl. You can also make a bet about whether there will be a government shutdown. And right now in the bettors market, they're saying 75% chance that we will have a government shutdown. I don't know whether congressional staff can use this bettors market. Certainly they have some inside information that we don't have. But if we do have government shutdown, then we're going to be disrupted again. Flood insurance is not available. The income verification. So some people got a mortgage, but they want to do the final step of verifying income, call the IRS, whether or not what the stated income matches what the IRS has. Well, IRS will not be answering the phone during that time period. Furthermore, in some of the rural communities in Maryland, where they have access to the Department of Agriculture home mortgage loan, zero down payment loan, that will not be available during the government shutdown. So definitely disruptive to our industry. But the bettors market is saying expect 75% chance of a shutdown. If it is a shutdown, let's just hope it's only a few days or 1 week and not the second longest or another longest ever government shutdown condition. Now, stock market today is coming down after hitting a record high yesterday. But there's a lot of question about whether or not it is overvalued. Housing wealth is also at an all-time high, but this appears to be on the solid ground. So anytime you have high wealth stock market, housing wealth, we are not in a recession. But there's some indicator where the economy is clearly weakening, or you can say K-shape. Some people are doing well, other people not doing well. And job gain numbers are definitely weakening. Consumers are saying they are unhappy, and consumers are beginning to default on some loans. And Greenland, tariff war, non-tariff war, who knows what's going to happen related to that. But at least that led to the U.S. Treasury yields rising, with Denmark saying they're going to dump the U.S. Treasury. That forced up the mortgage rate somewhat. So there are many, many factors at play, but let's go over some of this item. This is a Standard & Poor's 500 index. In recent years, the stock market wealth were driven not by 500 companies, but essentially by a dozen companies. 490 other companies are simply okay. They are not spectacular. It's only the 10, 12 companies that are spectacular. The usual tech titans of Amazon, Google, Facebook, Microsoft, you have it, Apple, along with some artificial intelligence computer chip maker. So any companies with exposure to artificial intelligence, Wall Street is saying, we will give you super amount of money to invest in artificial intelligence technology. Artificial intelligence, you are using it, it will continue to improve, and is with us. But the key question from the stock market is, can they turn profit? Now, of course, technology is good, but can they extract a lot of money from the consumers? And if not, then you may see some correction among these 10 companies. And if this 10 companies correct, it's bringing the whole S&P 500 down because it's really the 10 companies that's driving up this valuation in recent years. Now, consumer sentiment, quite amazing. It is very low, as you can see. What is surprising on this chart is look at the middle. That is 2008-2012 period. That's when we had the foreclosure crisis. We saw prices decline 30% during that period. Very distressful situation. And also national economic recession, 8 million job losses. We don't have net job losses aside from, say, the DC area from the Doge impact. Many states still adding jobs. And we have record high wealth, yet consumers are saying things really stinks about this economy. So consumers not happy about the direction of the economy. Now, if we look at the details of the sentiment, there is two components. One is about the future, which is the green line, and other line is the red, the present condition. So the present condition is question like, if you were to lose job, is it hard to find a job? While the green is saying that, what do you think about the future? Those type of questions. Same pattern as the prior. Today, it is low, lower than what it was in the foreclosure crisis. What is unique about this graph is the following. Americans are generally optimists. Even if today market condition is not the best, people still wake up the next day knowing that tomorrow will offer better opportunity. Green line is always above the red, except in recent years. In the past 3-4 years, as you can see, green and the red is the same. And I don't know whether this is the nasty political discourse that is having. You turn on the cable news channel, and whatever channel you turn on, essentially they are saying the other political party is evil. We are almost on the verge of a civil war. I mean, it seems like, at least the rhetoric in terms of how much distaste people have for other political parties. So maybe this is leading to where people are saying, America, we don't have a future, or at least that's what the sentiment index is indicating. So right now, it is low, lower than foreclosure, and also we are no longer seeing the optimism about the future in relation to today. Furthermore, the actual economic behavior is showing some stress. Auto loan delinquency, 3 peaks. First, foreclosure crisis. Second, COVID lockdown. Third, today, we are not in an economic recession, yet we are behaving as if we are in a recession. Now, if you look at the actual figure, which is 5%, which means 95% are paying auto loans on time. But normally, it should be 98% of the people paying the loan on time. So we are feeling some economic stress, and credit card delinquency rate are still rising. Now, President Trump has introduced a debate within the Republican Party. President Trump is saying, let's put a cap of 10% interest rate on credit card for 1 year because look at the distress people are feeling. While other Republicans are saying this is government interference, government should stay out of the market. So let's see what happens in this regard. But clearly, we see some economic distress on the credit card delinquency rate as to what's happening. Student debt. Well, during the few years during COVID, government said as part of the stimulus measure, you don't have to repay the loan. And official default rate was zero. People did not repay, and the default rate was zero. But now people have to repay, and people are saying, I cannot pay. So you see a high default rate condition. So people unable to pay, borrow money in the auto loan, credit card, and the student debt. Now, fortunately, people are paying mortgage debt. So mortgage debt is still, broadly speaking, being paid. So mortgage market is healthy, but we see other debt markets showing some stress. Therefore, given some economic stress, Federal Reserve is trying to prevent further exacerbation of this economic stress by cutting interest rate. So they cut interest rate 3 times last year, September, October, December. They did not do so yesterday, but they will probably do 2 or 3 more times before the summer finishes. So Federal Reserve, without a doubt, they will be cutting interest rate to avert some of this economic stress point that we are seeing, trying to stimulate the economy. But all of the realtors, people in the real estate industry would know that Federal Reserve policy does not impact mortgage rate 1-to-1, not directly. Everyone is focused on the first bullet point. Fed policy rate cut, mortgage rate should go down. In fact, you probably have some clients who say, look, I don't want to buy a home today. I'm going to wait until Federal Reserve cuts interest rate. Well, on the day when the Federal Reserve cuts interest rate, mortgage rate actually may rise. Yeah, you experience that. So it's not a 1-to-1 because mortgage rates are impacted by many, many factors aside from the first bullet. When we have high national debt, high deficit, more government borrowing, less capital in the mortgage market, higher mortgage rate as a result. Soon, Supreme Court will determine the constitutionality of President Trump's tariffs. Can the White House make an executive decision, or does it require a congressional approval? If Supreme Court negates President Trump's tariffs, well, the impact is, according to many estimates, Washington language, always over a 10-year budget cycle, $3 trillion in tariff revenue that would have come in would no longer come in if that's the case. So we have higher budget deficit, higher interest rate condition. Inflation rate. If the inflation rate is high, no lender will lend money at low interest rate because the money that is returned would have lost value. So they want to be compensated by charging higher interest rate condition. Quantitative tightening, without going into technicalities of it, essentially, is there more mortgage money? And 3 weeks ago, mortgage rate went to 5.99% average. That it was the lowest mortgage rate in 3 years. After 3 years of 8% mortgage rate, 7% mortgage rate, or in the high sixes, mortgage rate went to 5.99%. What happened during that day? Well, White House essentially saying Federal Reserve is not helping us, so let's bypass the Federal Reserve. Yes, let's utilize Fannie Mae, Freddie Mac, instruct them to buy mortgage bond, essentially to say buy more, bring more liquidity, and mortgage rate can go down. So mortgage rate went down to 5.99%. Then the next week, Greenland issue, and then Denmark was dumping the U.S. Treasury, tariff situation, so mortgage rate is now back up to 6.2%. But it could also, Federal Reserve is not the only player who can impact the mortgage rate. And there are other factors. To say essentially everyone is focused on the first bullet point, but there are other factors that impacts mortgage rates. So if I put the 2 lines together, Fed policy in the blue, while the mortgage rate what you care about in the red, you see the pattern. It is not one-to-one, but nonetheless, you do see over a long stretch or period, two lines appear to move similarly. So with a blue line anticipated to decline 2 or 3 more times this year, I think it's just inevitable mortgage rate will decline. The mortgage rate will go to about 6%, maybe even 5.8% condition. So even though it's not a one-to-one relationship, it does have some influence over a longer term period. So expect better environment, more people able to qualify for a mortgage. Annette discussed about how many additional people would qualify in Maryland region, individual cities like Baltimore County. So you see the impact from that. And the basis of it is Federal Reserve cutting interest rate few more times and thereby bringing mortgage rate down at some point, not on that particular day, a little lower. But note, Federal Reserve is cutting interest rate at a time when inflation is not fully under control. Today, when you go to gas station, it is cheaper. But when you go to grocery store, it is not cheaper. Medical expenses are rising, college tuition is rising. So overall, inflation is still running at 2.7%, higher than the desired 2%. Now, one reason, aside from, say, medical bill that's as to why inflation is rising, is this stubbornness. Home insurance costs misbehaving, rising 8%. I mean, you feel it. You feel it for your clients. So we know that. So this is contributing to the fact that why inflation is not fully under control. But when the Federal Reserve is cutting interest rate, when inflation is not under control, guess what happens? People want hedge against inflation. Throughout human history, gold has always served as an inflation hedge. So if people believe we will have permanently higher inflation, then this would be the condition with gold prices just skyrocketing. The gold necklace that your grandmother has in her drawer, well, it was very valuable. Today, it is much, much, much more valuable than what it was just a few years ago. So gold prices rising strongly because people want to hedge against higher inflation, a Federal Reserve cutting interest rate, even though inflation is not under control. Now, let me put this graph in the context of real estate. Gold is an inflation hedge, but throughout human civilization, real estate has also served as a good inflation hedge. Land prices, real estate prices. So to the degree that gold prices are skyrocketing like this, well, real estate prices simply cannot crash when this is happening. I know in the social media, there are some people who are saying, don't buy houses this year. Home prices will crash 30%. Wait until it crashes before buying. When gold prices are rising like this, home values will not crash 30%. So keep that in mind. Or maybe if somebody is mentioning about potential price crash, show this chart. Real estate also serving as an inflation hedge. Now, I am not saying real estate prices will move like this. No, I'm not saying that. What I'm just saying is counter argument about potential price crash simply cannot happen when the gold prices are rising like this. Now, job market, which Annette covered in detail, but let me put it slightly differently. This is how many paycheck that is being issued in America, people receiving paycheck. W-2 statement paycheck. Not small business owner with fluctuating income and not the commission income of realtors which fluctuate, but teachers' income, people working for federal government, nurses, people receiving W-2 statement. Right before COVID lockdown impact, then as the economy reopened, more job, now with 7 million more people receiving paycheck. Record high, which should mean that we should have record high home sales. But we don't. We don't have record high home sales either because people don't believe in the American dream of ownership anymore, which I don't think is the case. I think everybody wants to own if they can. But it's simply that mortgage rates are still high and we are lacking in inventory. So what we really need is more inventory and also lower mortgage rates. Now, as to getting the more inventory, last week we had the what we call NAR Advocacy Conference. few important realtors from Maryland were at the event. And essentially, we were talking about how do we bring more inventory? And we brought 4 members of Congress who are part of the Real Estate Caucus. Members of Congress who are interested in real estate issues. It started very small, but today it's up to 120 members of Congress who are part of the Real Estate Caucus. But these 4 people who came last week in NAR conference, they are the leaders of their political parties. Democrats, Republican, 2 Republicans, 2 Democrats in the Real Estate Caucus. And they said the following: let's lift the capital gains exemption. The capital gains exemption no longer works in today's economy. We don't want homeowners to pay this capital gains tax when they are selling their home, especially among the elderly who bought their home 30 years ago. Now, huge capital gains, and their tax accountants are saying, don't sell your home. You're going to be hit with a tax. And that's unfair because they're not going to the right size home. So by lifting the capital gains tax, number one NAR advocacy issue this year, we will have more inventory come onto the market, more people moving into the right size home, and then with a combination with lower mortgage rate, that would be a positive thing. So going back to this graph on jobs, view this as a potential housing demand. So potential housing demand is record high, even though actual demand is low, but actual demand can begin to pick up once we have more inventory and mortgage rate decline. Now the job number, the same figure, let me show you slightly differently. So rather than total number of paycheck, how many new paychecks are we adding each month? And it is near zero for several months, near zero, circling around zero. And one contributor to this is something we are all familiar with in this region, is the DOGE impact. Federal government employment below COVID condition. Back in 2020, look the number, look what's this today. So far fewer people working for the federal government, therefore impacting lower job creation. But we also hear from the private sector, banking industry saying we're not going to hire people. Amazon laying off people. FedEx laying off people. So we know it's not only the federal government, but the private sector also showing some weakness. Now let's look at state by state comparison as to where the jobs are being added in the past 12 months and where jobs are being lost. Unfortunately, Maryland, District of Columbia, maybe this is part of the DOGE impact, we are negative. So Maryland is down slightly, District of Columbia down a lot. So most states positive, but not in Maryland, unfortunately. But if we look at 6-year time span, from pre-COVID to today, every state is positive except for District of Columbia. So Maryland is positive by small amount, is color-coded. Greens are showing fast job addition. Carolina, super fast job addition. Maryland added 2.0% more job. It's on the right-hand column towards the middle, Maryland 2.0. District of Columbia, they really suffered during COVID. During COVID lockdown, people said, I'm out of the city. I'm going to go to Maryland mountains. I'm going to go to West Virginia. So it's recording where people are receiving their paycheck. So a federal government employee, if the person is receiving the paycheck in Maryland, it will be counted as Maryland job. So, during COVID, people fled the District of Columbia City. So DC is negative, but Maryland positive, but not that spectacularly positive. And just to show you some figure, here's the District of Columbia, just the city itself. Right before COVID, people said it's a recession-proof economy. And you can say, well, yeah, it looks like a recession-proof. Then COVID hit. People left the city. Then look at the last data point, big decline. That's the impact of DOGE that happened in September. In the meantime, Maryland is at a record high, but modestly, not a dramatically, but record high employment. It's not a straight line, so it's not a recession-proof economy. So you see in the middle some job losses. Then you see the COVID sharp decline during COVID, but today essentially at a record high, even though the last data point is showing slight decline, but still above pre-COVID condition. Record high, near record high employment. We should have near record high home sales, but we don't because of high mortgage rate and lack of inventory. Among those people with job, at least their standard of living is beginning to improve by small amount. Blue line is wage gain. Red line is consumer price inflation. So as you can see, wage gains are slightly above consumer price inflation. So at least among people with job, remember, we're not adding more new jobs, but among people with job, their standard of living beginning to improve. Now, as to the housing sector, this is a nationwide statistics. First bar is 2019 pre-COVID. Then when COVID hit, well, we had a frenzy activity because of low interest rate environment, frenzy multiple offer. But when the Federal Reserve raised interest rate, you see how the sales are declining. And for 3 straight years, very difficult business environment, 75% of normal activity. Nationwide figure, but pretty much everywhere across the country showing similar pattern. Maybe some local market is 80% of pre-COVID, other local market 65%, but you see it is very low condition. Now, builders are back to normal because builders have one thing that the realtors cannot do. Builders can create inventory. So because they have inventory, at least they can get to the pre-COVID. So realtors are waiting for their past client to list property, or maybe changing the capital gains exemption will really lead to more inventory coming onto the market. Builders doing little more business. Maryland housing statistics, Maryland realtors do a great job in providing the statistics, Bright MLS as well, and I'm sure you have access to your own data point. And of course, we have our dashboard to show you some scenarios, including we have a scenario where if the capital gains tax is not lifted, but prices continue to rise, say another 10%, how many people in the Baltimore region, how many people in Annapolis are impacted on the capital gains tax? So those information are available in our dashboard. But looking at Maryland Association data, you are seeing that in 2025, you were down 3% in terms of unit sale, down 3.1. Nationwide, 0. Then you look at the inventory condition way on the right hand lower. So go to the right to the bottom inventory. Look at this. You are very tight on inventory. So the reason why you don't have enough sales is you don't have inventory. So if you had more inventory, you can get more sales done. Now, one good part as related to your clients is prices are still rising. And we know that 40% of you, 40% of the realtors have investment property. So your investment property prices have also risen. So your commission income was not coming in, but your investment income, real estate income was coming in because of the strong pricing gain that you see. Continuing, this is the home price trend from pre-COVID to recent 5-year change. Maryland, the price gain of 45%. DC had the lowest price appreciation of 14%. But Maryland, 45% appreciation just means that someone who had a $500,000 home, now that home is above $700,000 prices. So you see the price point rising because of the strong price increases. And that's why we need the changes in capital gains exemption limit condition. Net worth, consequently, for homeowners, real estate investors, record high. And this is on solid ground because you saw the gold prices, why prices will not decline. But here's another chart to show. People are not defaulting on their mortgages. People are not doing foreclosures. So very little condition. So with so few distressed property sales, don't expect any type of a home price crash. Definitely not like the middle of the graph, the foreclosure loan blow up, subprime loan blowing up during 2010 period. We are not like that. And one positive sign is mortgage application to buy a home has been on the rise in the past 12 months. So you see that in 2022, it collapsed when mortgage rate went up. Then we were at the low point, but throughout last year, it's been rising. Home sales did not rise because mortgage application includes mortgage denial. So your clients who may have been denied at 7% mortgage rate, try it again at 6%. Today, mortgage rate is 6%, and they may qualify. So keep trying at it. So this is a good expression of wanting to buy. And consequently, my last final slide is the following forecast. 2025, bummer. Maryland, you saw you were actually down slightly. But 2026, I'm anticipating a solid gain of 14%. Now, it's not going to be 14%. Maybe it's 10% gain or maybe 17% gain. We have to wait and see about it. But I feel optimistic. Maybe the first couple of months is going to be a little soft. We have this, intense cold weather, snow disruption impact, and maybe even government shutdown disruption. But I think things are lining up well, particularly the mortgage rate forecast. Look at the line on mortgage rate. Assuming 6% mortgage rate, our statistical model is implying 14% growth in home sales, 14% growth in home sales. I got a lot of resistance from realtor brokerages, large brokerages, to say that I am way too optimistic. And my reply is, as long as we are adding job, even though it's more sluggish job addition, and mortgage rate goes down, more inventory show up, this is what my statistical model is suggesting. But they still think I'm way too optimistic. So let me use different story, not a statistical model, as to how you can see the 14%. Housing industry is a cyclical business, goes up, goes down. We all know that. In the past years, when the housing was down and it began to recover, it was actually very common to see a double-digit percentage gain. So it's not an abnormal thing to see a double-digit percentage gain. Furthermore, we have a record high number of jobs in the state of Maryland, but we don't have record high home sales. This 14%, we are not back to pre-COVID. After 14% increase, we need another 15, 16, 17% growth to get us back to pre-COVID condition. So this is a recovery year. We're not back to pre-COVID condition. So lower mortgage rate, housing being cyclical, I think we are beginning to show recovery, but the recovery of double-digit percent is quite often normal condition. So at least my forecast, forecast is never a guarantee, is implying that you will have a more business opportunity this year in 2026. Maybe first few months will be difficult, but with the Federal Reserve ready to cut interest rate in spring, summer months, I think you will see more people qualify for a mortgage, more people able to enter the market, and a huge game changer. I did not have it in the model, but if we do have it on the legislation on lifting the capital gains exemption, then we are going to have a spectacular year in 2026 or even 2027. So thank you for inviting me and my staff to share some of our thoughts with you all. So thank you very much.
Thank you, Dr. Yoon. We do have one question here, if you don't mind me asking, from one of our listeners, watchers. And that is, why do you think the VA people, Virginia people, cut by DOGE have regained jobs much more quickly than Maryland? Is Maryland not generating sufficient jobs that are non-governmental?
Maryland has a uniqueness in the health sector. National Institute of Health are very heavy, but you can also say those are government funding contract situation. Virginia has some tech exposure, especially the data center condition. And Virginia state geographically is large. You have Richmond. Richmond is one of the market that is seeing a good job growth. So Richmond is so far away from DMV, they're not really DOGE type of employees. So I think that partly explains the number in terms of the job situation. But still, we have to ask the question, why are the Carolinas just booming while Maryland and Virginia, relatively speaking, are trailing behind Carolinas?
Absolutely. Got another question here from John. Where are the job gains that you're forecast in Maryland? Where are they coming from, the job gains?
So I don't have a specific sector model part, but in any given year, in a normal year, we would have about 2 million, 2.5 million nationwide job gain. And it's not necessarily a low wage job gain. Typical wage tends to be right on the average. Some low wage jobs, some high wage job. It could be accountants, it could be nursing job, it could be teaching profession. So it could be wide, varying number of jobs. So when the macro economy moves, so broad economy moves, it seems to move the all sectors of the market. Now, of course, DOGE, federal government employment is a very unique situation in the current business cycle. So I cannot precisely state where the jobs are coming from, but broad macroeconomic recovery leads to broad across the board sort of job gain, even though in my forecast, I have the job number as slightly above 1 million nationwide, even though normal nationwide recovery should be more like 2 million or even sometimes 3 million. So we're not going to get that robust job creation, but still a job addition.
Thank you. Thank you. You talked a lot about capital gains, lifting of the capital gains. What about, or how would that affect people who are locked into some fabulous mortgage rates and just are hesitant to sell their house, even if they want to, because of the mortgage they currently have?
Yeah, that's very good. So after this, maybe one more question after this, just for my time's sake. Those questions are very good. So your clients who have expressed they have 3% or you have 3%, and you said, I am never going to sell my home. So when people have expressed that, they are sincere. They are sincere in their expression. But with the passage of time, what we are finding is people are changing their mind because there are major life-changing events that occur for some people, even with those with 3% mortgage rate. Maybe there's a death in the family and they have to readjust, so they have to list the property. Certainly, Doge impact. Some people may want to sell their property onto the market. People found job in different town. They are selling it. Maybe they have additional child in the family, and that small size home is no longer fits. They need a larger size home. They have to give up that low 3% interest rate in order to go into a larger size home to better meet the family condition. So there are a variety of life-changing events. Passage of time just means more people will face life-changing events from the time they were locked in. So many people are locked in, but there will be less significant lock-in effect over time, some loosening with the passage of time.
Awesome. Okay, quick house cleaning question. Then I have the final question for you. Do we have access to your slides and are not slides today?
Yeah, so we will send that
Okay.
over and you are welcome to distribute to Realtor members.
Okay, thank you so much. And finally, for your last question, how does the property tax rate in Maryland influence your calculations?
I have not done a analysis on the property tax part, but I can say just directionally the following. Just like the property insurance, if the property insurance rises, people do not want to buy home. That's extra cost. Condo association fee rising in Florida. People do not want to buy condominium in Florida. So any additional cost, there's less demand as a result. In state of New York, upstate, Buffalo, low home prices, it's very common to see property tax payment, annual property tax bill is higher than the annual mortgage payment. But the Buffalo prices are very affordable, or you can say prices are not rising because people. So anytime you have higher property tax, you will put a little dent on the price growth potential.
Well, thank you. Thank you. Well, thank you, Dr. Yoon, and thank you, Anat Nusinovich, for your participation today in today's economic forum. We really appreciate your insights as always. So thank you. Safe travels back to where you're going, Dr. Yoon, and thank you all for joining us today.